The Federal Reserve, or the Fed, is like America's central bank. It sets interest rates for banks to borrow money. These rates impact how much banks charge you for loans, including credit cards. When the Fed cuts rates, borrowing costs typically go down. This can be good news for your wallet. However, the connection isn't always immediate or direct. Banks don't always pass on rate cuts right away. It's crucial to understand how these changes might impact your credit card debt and what steps you can take. Imagine the Fed rate as a pebble dropped in a pond. The initial impact is small, but it creates ripples that spread outward. When the Fed cuts rates, banks have more incentive to lend money at lower rates. This can lead to lower interest rates on mortgages, auto loans, and yes, credit cards. For credit card users, a Fed rate cut can mean a slight decrease in their annual percentage rate, or APR. This is the interest you pay on your credit card balance. Even a small reduction in APR can save you money over time, especially if you carry a large balance. However, it's essential to remember that not all credit cards are created equal. The impact of a Fed rate cut will vary, depending on the type of credit card you have. Credit cards generally have variable or fixed interest rates. Variable rates are tied to a benchmark rate, often the prime rate, which moves in tandem with the Fed rate. This means that when the Fed cuts rates, variable APRs usually follow suit. However, there might be a lag of a few months. Fixed-rate cards, on the other hand, maintain the same APR regardless of market fluctuations. If you have a fixed-rate card, a Fed rate cut won't directly affect your interest rate. However, it might be a good time to compare offers and see if you can snag a lower rate with a new card. Section 4. Strategies for savings making the most of rate cuts. So, the Fed cuts rates? What's your next move? First, check your credit card statements. Confirm if your APR is variable or fixed. If it's variable, monitor it for any decreases in the coming months. Remember, even a small reduction in APR can save you money over the long term. If you have a large credit card balance, consider a balance transfer to a card with a lower APR. This can be especially beneficial if the Fed rate cut leads to lower introductory rates on balance transfer cards. However, be mindful of balance transfer fees, which can sometimes offset the interest savings. Section 5. Navigating the credit card maze. Beware of tempting offers. A Fed rate cut often triggers a flurry of credit card offers with enticing introductory rates and rewards programs. While these offers might seem tempting, it's crucial to exercise caution. Don't be swayed by flashy perks alone. Evaluate your spending habits and choose a card that aligns with your needs. Focus on cards with low or no annual fees, reasonable APRs, and rewards that you'll actually use. Remember, the goal is to manage your credit responsibly, not accumulate unnecessary debt. A Fed rate cut can present opportunities for savings, but only if you make informed decisions. Section 6. Your financial game plan. Practical steps to take advantage. Here are some practical steps to take advantage of potential Fed rate cuts. 1. Review your credit card statements. Identify cards with variable APRs and monitor them for any decreases. 2. Explore balance transfer options. Compare offers and consider transferring your balance to a card with a lower APR, but be mindful of balance transfer fees. 3. Evaluate new credit card offers carefully. Look beyond tempting rewards and focus on cards with low fees, reasonable APRs, and rewards that suit your spending habits. 4. Prioritize debt repayment. Use any potential interest savings to pay down your credit card debt faster. And 5. Seek professional financial advice. Consult a financial advisor to discuss your specific financial situation and develop a personalized strategy. Remember, knowledge is power when it comes to managing your finances. By understanding how Fed rate cuts work and taking proactive steps, you can potentially save money and improve your financial well-being.